the sort of transaction that we do, you need some element of relentless. If you want to transform business, if you want to change businesses, you have to really believe that you're right in your approach.
The headline was, when the going gets tough, the tough get bidding. So do you think there's also something about the personal profile or the characteristics of the individuals involved that are suited to this market?
I think that characterizes really well my transactions, and what we do at Cap10 is they're never obvious. So they require some work, require some digging, they require some understanding, but actually the more time you spend on these businesses, the more you tend to like them.
I saw on your LinkedIn there are a few deals that you specifically call out with at each place you'd been in, and the Watches of Switzerland one is always the one that it's easy to remember. I'm actually feeling very self-conscious about the watch over right now. You probably describe it as entry level.
And then once we run through some of the numbers and the bridge, suddenly Rob and I look at each other, we're like, have we missed a 150 million euro liability?
Welcome to Life of a Dealmaker, the Mayer Brown private equity podcast, in which we talk to senior members of the private equity community about their career highlights, lowlights, investment thesis, and everything in between. We hope you enjoy it. Fabrice, welcome to Life of a Dealmaker. This is the first episode being recorded in 2024. And so I feel like a good place for us to start might be resolutions. So first of all, are you somebody who believes in, at the start of a year, goal setting, resetting, and thinking about what the objectives are to try and do in that calendar year? And if so, what is that for Cap10?
Well, good afternoon, Tarun, and thank you for inviting me to Life of a Dealmaker. I'm very happy to be here with you. Listen, what I try to do, and that's something I really got into the rhythm with, or obviously running the firm, is try to set up objectives on a sort of quarterly basis with the team, sort of every 3-4 months to set the objectives of the firm. So yes, the beginning of the year is a good moment to do it, but I try to do that sort of 3 times in the year. So the first beginning of January, then sort of at the end of the first quarter, and then after the summer for the last quarter. And so, yes, I try to do that on a regular basis. So there are some good resolutions for this year, and we're still building the team. And I'm very glad to the team we've built so far, but we still need to add a few more members to the team. So that's one of our priorities, as well as keep some good deployment of the capital that we have in the fund. We think it's a very attractive moment to be putting capital to work. We think it's a very attractive moment in the cycle, and so we're out there creating a lot of attractive investment opportunities at the moment. So that's really the second priority, and on the back of that, we'll then raise more capital with a seeded portfolio.
I mean, it's very interesting you feel that way, because I think it's fair to say, definitely in the last 2 IPEMs, private equity conferences in Paris and Cannes, that the mood has started to shift in the panel sessions. I think it's probably the one before last. You could say it was cautious. The last one, you're probably entering into kind of a gloomy outlook. You're obviously looking at it very differently. So, what, from your perspective, why is it that you and Cap10 are in a good position to be able to buck, I guess, what the market is saying?
Well, I think we've seen this before at Tarun, right? This market goes in cycle, and people tend to do a lot of deals at the peak of the cycle and reduce materially the investment activity and investment deployment at the bottom of the cycle, where you should really be putting capital to work, right? Why is that? Because typically people have put a lot of capital to work at the top of the cycle, so they have to look after those investments, and then secondly, financing is harder. A lot of the market, as you know, in Europe is still secondary, tertiary LBOs, which are obviously you're facing sellers which don't need to sell at that point in time in the cycle. And it's very hard to meet buyers and sellers' expectation given the suboptimal debt financing market. And for secondary or tertiary deals to work, you typically need optimal financing This is not what we do, right? So we have, first of all, we don't have any past issues in our portfolio because we're in the process of building the portfolio. So secondly, all deals that's much more primary-like in nature. And so is what I call good business, wrong owner. It tends to be what we do. So think about public to private, corporate carve-outs, distressed seller situation where multiple shareholders with misaligned interests. This is typically what we do, where people typically have to sell for specific reasons, whether it's because corporate carve-outs, they need to sell that business to then reinvest in the core business. And so we're in a situation where there is a deal to do, and meeting sellers and buyer expectation is a lot easier. Or deals are also a lot less leverage dependent. Yeah. And so that makes the deals a lot more executable, even at a time when the debt markets are inefficient. And so I think it's a combination of all those factors that I think leads us to be able to be very reactive at the moment. It's a mix of the type of transactions that we do, combined with the fact that we have a lot of capital to deploy and know what I would call sins from the past.
Yeah, and we'll come back to Cap10 in more detail later on in the podcast. But just touching on, that reminds me of, I know you did an interview, probably the last one you did in the Times, where the headline, I'm not sure whether the quote was attributed to you, but the headline was, when the going gets tough, the tough get bidding. So do you think there's also something about the personal profile or the characteristics of the individuals involved that are suited to this market, as well as kind of the investment thesis?
Well, I think those go together to some extent, right? It's the individuals that create the investment thesis.
Yeah.
So, well, if you go back a bit in history, so as you know, I spent almost 10 years at Apollo. And I joined Apollo in 2011. One of the main reasons I joined Apollo at the time was, I went through 08, 09, and that period where literally nothing happened in the market, or very few players were active at a point in time in a cycle where it was actually really attractive to make investments, right? And people who made investment in 08, 09 have done extremely well. Yeah. In 2011 in Europe, if you remember, Greece was about to leave the euro, Italy, Spain. The question was, when is Europe going to implode, right? And so the macro environment was very complex and with very little visibility. So I wanted to join a firm who had the ability to deploy capital across both sides of the cycle. And I can't think of a better firm than Apollo, who knows how to deploy capital at the bottom of the cycle. I think there's some stats in 08, 09, I think Apollo deployed 60% of the capital in the whole private equity space in the US during that period.
Wow. Yeah.
And they're buying debts at 20 cents in the dollar by the billion. And so I was really keen to acquire that skill set to be able to really be active in both sides of the cycle. And that's really something that I built during my time at Apollo. And that ability to deal with complex transactional situations. So our first deal, sure service, a public to private. I think that's the first in the history of private equity, having a fund starting with a public to private as an investment. And so that ability to deal with that sort of complex transactional situation is clearly a differentiator in the mid-market space. And so to answer your question, it's a mix of the skill set and the sort of transaction that we look for, combined with the environment that we're in, which makes us very, obviously, it's a great time for a Cap10 strategy at the moment, for sure.
Yeah. And so rewinding to the start of your career, we've already deep dived into some elements, but I do like to try and keep a degree of chronology so we get through the thinking all the way across your career. So you started obviously at ESSEC Business School, very well renowned school, and I'm interested in two decisions that you made having graduated from there. Number one is to go into private equity, and then number two is geography, because also you came to London. You could have gone to a lot of other financial super cities. So starting with the first, how did you get to deciding that it was private equity where you really wanted to focus?
So I've always had a sort of particular ability with numbers. So finance was an obvious place for me to land. And so during my time at ESSEC, I tried to have multiple professional experience. We had to do lots of internships. So I spent time in equity research, then I spent time at Merrill Lynch in M&A, and I had a third internship to do at the end of business school. And so doing another internship in M&A felt like it's going to be a bit more of the same. And then I got exposure during my time at Merrill to private equity. That was back in 2001, 2002. And CVC at the time, I think still is actually hiring interns for like 6 months period. So I met with the team at CVC in Paris, got along really well, got an offer to join them for 6 months. The 6 months became 9 months, and I got to be involved in pretty much 95% of my time on one transaction that got signed and closed. It was just, lucky, right time at the right place, but absolutely love that experience. So I came out of this, finished ESSEC 3 months later, and I was extremely clear that I was going to do private equity for the rest of my career. So the question is, what's the best way to do that? And I had done all my internship in Paris, to answer your point around location. So, but like, if you're going to work in finance in Europe, well, London is kind of the place you have to be. And so it felt like I absolutely needed to spend time in London. And so I took my Eurostar ticket and arrived in London, joined UBS in the M&A team in July 2003. And then I was planning to spend a couple of years and go back to Paris, and well,
the rest is history.
Exactly. 20 years later, I'm still here.
And so then going on to the location aspect, it thrills me to hear that, somebody's telling you that London is the place for you to go and do finance. I'm quite interested to know do you think somebody in Paris, if in an internship scenario happening today in 2024, do you think they'd say the same thing about London?
Listen, I think if you want to build a career in finance, especially in corporate finance, I still think it's happening here. And if you want to have also a pan-European exposure, and if you want, during your investment banking time, if you spend time in investment banking, exposure to the different products of investment banking, whether that's M&A, leverage finance, equity, etc., you have to be in London, because that's really where all the different products, all the different sectors, and that's also where you get a pan-European exposure. If you're in Paris, you're going to be pretty much limited to the French market. And if you're in Frankfurt or anywhere else in Germany, you're going to be focused on the German market, or even sometimes your region in Germany. If you want that pan-European exposure, you have to be in London still today.
So you do a couple of years at UBS, you then go to Lion Capital, which is consumer brand focus. Is that right?
Yeah. That's right.
How was your experience there?
Listen, it was exactly what I wanted it to be. So the reason I decided to join what wasn't even called Lion when I signed my offer, it was somewhere between Higgs and Lion at the time. And so the reason I joined the firm was I wanted the best of sort of a blue chip environment combined with an entrepreneurial environment, which are typically two things that are sort of a bit opposite, right? It's hard to combine the two. I've had that experience at CVC, which was very hands-on. I had lots of exposure and responsibilities, so I wanted that. I didn't want to join investment banking 2.0. But at the same time, I wanted to also work with people that had really a blue chip experience from some of the best firms in the industry I could really learn from. And so I was trying to combine those two elements. And Lion was that perfect mix of the team that had effectively built the and invested Higgs Mutual Fund 1 in Europe that had gone really well, combined with a senior partner from KKR. We had that sort of blue chip, large cap firms background, but in a very entrepreneurial setup where I was literally employee number one at Lion Capital.
You were employee number one?
Yeah, I was employee number one. And by the time I actually joined 4 months after I signed my offer, it was 4 associates in the team, the 3 founding partners, and every deal team was basically 1 founding partner and 1 associate. It was a deal team of 2.
Yeah. So you effectively found a way to mimic your internship experience that you had at CVC in terms of exposure and depth of what you got to see on a deal.
Yeah, I was really keen to join a firm where I could see the whole life cycle of the investment, from sourcing to deal execution, every aspect of the deal execution and the portfolio management as well. Really living through the whole life cycle of the transaction and having exposure to every part of the deal process and as much responsibilities and ownership as possible. And so, and that definitely lived through my expectations.
And so then you get to Apollo. You've already explained what led you to go to Apollo. You were there for almost a decade, just
Yes.
over a decade, a long time. So how did the role change and develop over time? And what do you feel were kind of the peaks of that experience?
Listen, it was another really exceptional experience. I mean, I have only positive things to say about Apollo as a firm, and I'm really glad for the opportunity I was given there. So I joined the firm just after the financial crisis when so Sanjay Patel had been hired by Lee and Mark and George to run the business in Europe and rebuilding the private equity team. And so I was one of the, again, first members of the team to join. And then we built it to a team of, I think today is probably about 25 people within the private equity team, and which has been very, very successful and has achieved great returns during the last decades. And so it's been an amazing experience from that point of view. I've really learned a tremendous amount when I was at Apollo. The level of sort of sophistication, creativity, and discipline of the firm, I think really was a phenomenal experience for me. And I got to learn again. At the end of the day, you build a business by experience, by doing, but also a lot by seeing other people do. And I had exposure to some really incredible investors within the firm and some amazing experience. And when you're sitting in investment committee and you got Leon Black telling you about this deal he saw 25 years ago that had that and that characteristics, and so you got to be careful about this and this. And is an encyclopedia of the investment world. And so having that exposure and the learnings you get from having exposure to some of these investors was really a great opportunity. And I developed a lot of my existing skill set during my time at Apollo.
I saw on your LinkedIn there are a few deals that you specifically call out at each place you'd been in, and the Watches of Switzerland one is always the one that it's easy to remember. I'm actually feeling very self-conscious about the watch right now. You probably describe it as entry level, but what is that? Is it fair to say that was one of your favorite deals, or what are the ones? What are the deals that you think of as transformational in a personal context for you at your time at Apollo?
Well, I think that's a perfect example of sort of transaction that I like to do, and probably the one I'm the most proud of. So Watches of Switzerland, which wasn't called Watches of Switzerland when I bought the business, was the first acquisition I did when I joined Apollo. So I was less than a year at the firm, sold the transaction. It was a broken deal. The business was owned by a bankrupt Icelandic bank, Landsbanki. So back to my story of good business, wrong owner, it's hard to think of a worse owner for a luxury watch retailer than a bankrupt Icelandic bank. Yeah. The business was a small business based in Leicester, doing about 300 million of revenue, 20 million pound of EBITDA, only focused on the UK, with a leadership position with about a 30% market share at the time, which is very unusual to have one player in a specific retail vertical to own such a large market share. With a market that was otherwise very fragmented. And the business had been underinvested given the nature of its ownership and really needed to be professionalized in a value chain in general that had not been very professionalized because it was a lot of small mom and pop family-owned businesses. Yeah. And so I saw an opportunity that really to professionalize the business, professionalize the value chain as a result, and really take leadership in the category and drive significant market share gain as a result. And so we embarked in a significant professionalization of the business, a massive reinvestment program. We increased materially the amount of capex, marketing spend, etc., which most people talk about private equity trying to reduce those. We actually significantly reinvested behind the business, which drove a tremendous amount of organic growth and market share gain. And the business grew like for like at double-digit rate every year, increased margin every year. And by the time we took the business public, a few years later, we had tripled EBITDA organically. It's a business that it's an acquired taste. Most people, when you start talking about a business, and I've had that experience multiple times, even during the IPO process, people typically have preconceived view around multi-brand retail in particular. Well, retail in general, multi-brand retail, the category, The brand is intermediating, so there's a lot of preconceived ideas that you have to go through. And but the one thing I've seen on multiple occasions is the more time you spend on it, the more you actually like the business, the more you realize it's actually a great business. But it takes some convincing. It's not an obvious one. And I think that characterizes really well my transactions. And what we do at Cap10 is they're never obvious. So they require some work, they require some digging, they require some understanding. But actually, the more time you spend on these businesses, the more you tend to like them and realize how good businesses they are.
And so it feels like there's, just by their very definition, the type of looking for trying to do something which is not obvious. And it seems like that's a bit of a theme across your career, not just solely at Cap10. It probably also means that there's been scenarios where it's not gone how you'd have liked it to. Can you, because I mean, so far the career story is obviously all extremely uplifting, very positive. Is there a point at which you think, actually, that's a low light, or that's something which I had to really dig deep to learn from in your career so far?
So I think probably the most valuable experience was the first deal I worked on when I joined Line, and that defined a lot of my investment philosophy. So we, back in 2006, a year after I joined Line, I was obviously a young first-year associate. We acquired this business called La Senza, which was the largest retailer of lingerie in the UK, owned by Theo Paphitis, the Dragon's Den. And then Theo left the business with his team, and so we had to recruit a new CEO. And we made a bad recruitment decision at the time, and which led to a lot of operational issues across every aspect of the business, which all of that accumulated in September 2008. And so the business, which had, when we bought it, was doing 10 of EBITDA, by the 15 months later was doing about 15. Within 3 months, went from 15 to 0 at the back end of 2008. And all of that was a result of some of the operational and commercial and strategic decisions made by the CEO we had hired. So that taught me one absolutely incredible lesson for the rest of my career: is the most important decision when you make an investment is the person who's going to run the business. After the investment itself is the person who's going to run the business. But and that can, the difference between an amazing CEO and a good CEO and an average CEO is not, it's not 10 or 20 bips of returns, it's potentially multiples of MOIC. And so one of the aspects we are hyper focused on is really the quality and of the management team that we bring to the business. And that's an essential part of our value add. And that is also, to be honest, Tarun, one of the things I enjoy the most in what we do is interacting with really talented managers, understanding what they've done in previous transactions, previous businesses that they've led, the sort of things they've done to the business to really create value and create long-term strategic value to businesses. You learn a huge amount from these people. And so that probably the thing I enjoy the most is meeting as many of us, like great CEO with transformed businesses, and use all that experience and knowledge to then use that in the context of new businesses and new opportunities we look at, but are not necessarily seeing the impact of a great CEO. And then bring those amazingly talented managers to then really lead the transformation and share the vision with or plan for the business and implement it. And that's really what gets me the most excited about what I do is interacting with really talented managers.
Yeah. Okay. Well, that's highlight and low light, and then I think that's a good time for our rollover question, which is also a variation of the same theme. So this is from Zaina Bain, who's my guest on episode 2, managing partner of Sullivan Street. Tell us the most funny story you have from a historic deal.
Oh, I've got quite a few of us. I would say it's a moment of panic which turned into a moment of like laughing once we realized that it wasn't that bad. So 2015, we just signed the Veralia transaction, so about a $3 billion carve-out out of Saint-Gobain buying the largest glass packaging manufacturer in Europe. The deal team was me, an associate, and Rob Seminar, which was one of the senior partners at Apollo. We know runs Apollo in Europe, and we're writing the email with the final detail of the transaction to the committee in New York after having signed the transaction. And then once we run through some of the numbers and the bridge, suddenly Rob and I look at each other, we're like, have we missed 150 million euro liability? And we actually paid 150 million more than we thought for the business. And like both of us look at each other like this moment of complete panic.
I can see even now you're not laughing. You're not properly laughing.
No one was laughing at that point. And we looked like each other like we understood exactly what the problem was. We didn't even need to talk. We looked at each other like, ooh. And then happened that it was a plus and a minus, and so
it was fine in the end.
Yeah.
How was that funny, Fabrice?
And well, it was really funny afterward, and we talk about it laughing now because it was such a moment of complete panic.
Yeah.
And which took us 2 to 3 minutes to like, okay, let's look at the numbers in detail. Let's make sure we've not missed something. And we were like, all right, that's fine.
Everything's going to be okay. I think we're back onto Cap10. So you then, having had a really successful time at Apollo, very happy there, felt that you'd learned a lot, you made the decision to then go and found Cap10. I think we've probably covered already a lot of the themes as to why you felt like you wanted to go in that direction. But what would you think of as the key drivers to wanting to go and set up on your own and put your imprint on a new PE firm?
Listen, it's driven by a few things. One is a market opportunity and timing. One of them I got right, the other one I got wrong. The market opportunity was, at Apollo, the fund becomes bigger and bigger. So we ended up doing really what I call elephant hunting. So the last deal I worked on was the acquisition of Asda, which TDR ended up buying. We were the cover bid, and that was just before I left. So doing about 6-7 billion pound transaction. Yeah. And those are fun, but they're so far in between, right? So you find one of those every year, every 2 years if you're lucky, right? I saw a real opportunity to go down in size, go back to where really I started when I started my career at Line in terms of deal size, where there's a lot more depth of transaction and a market where you find a lot of those primary lack opportunities and fewer people to address that part of the market. And so my whole idea was bring the Apollo skill set, the very sort of creative and disciplined and sophisticated approach of an Apollo into that lower mid market. So call it 100 to 200, 300 million pound or euros transaction. So that for me was the opportunity. The second part was timing. So I negotiated, I didn't want to leave without capital. So I negotiated a 300 million euros seeding agreement with a cornerstone investor. I really started actively the discussion in March 20. If you remember, we were in March 20, we were all stuck at home.
Yeah. that month, right? That month.
Yes. Yeah. It was literally, we had been kicked out of the office at Apollo in, I think, mid-February.
Right.
So the first time I met Edouard Carmignac was in March 20 in Zoom, obviously. And I was really excited about the opportunity to basically build a new pool of capital that we would deploy in that COVID environment. Right? So it was back to the 08, 09, great time to be deploying capital. COVID is going to create a similar environment. It'll be a great time with a brand new pool of capital, great time to be deploying capital, great time to be hiring a team and building talent, because at the end of the day, that's all we have in private equity firm is people and talent. Right. And so I felt that was going to create a really attractive timing and opportunity to effectively build a portfolio and build a team. Well, that's the Yamlan I got slightly wrong. But by the time all of that got negotiated, I resigned from Apollo in September 20 and then started Cap10 on the 1st of January 21. And here I am, 300 million euro of capital in a market that was not exactly the disrupted market environment that I was expecting.
Yeah.
It was actually back to the crazy days of obviously huge amount of deal activity, very high multiple, lots of debt available, fight for talents, etc. So when I started Cap10, I ended up being in a very different environment than the one you would have, to be fair, logically expected would happen with COVID, right? I don't think anyone expected that it would create an M&A boom at the time.
Yeah. And other than timing, is there anything, you're a few years down the line now, obviously, and you have a deal would you, if I was to give you a blank piece of paper now and say, start Cap10 again tomorrow, is there anything, taking out of the equation macroeconomic climate, so more about the way, the fun, is there anything you would think I would do that differently?
There's plenty of things I would do differently. Isn't it? The first time you do something, you rarely get everything right? And listen, and I haven't had the experience of building a firm before. I knew what type of investments I wanted to do, etc. But I was clear on the strategy I wanted to pursue. But I had not built a firm before, and building a private equity firm is a lot more than just doing good investments. Yeah. And so, there's plenty of things I would do differently for sure, and plenty of good lessons learned. I'd say for me, the main element is people and team, and really being very clear on the profile of people you want to attract in the firm, the culture you want to set at the beginning. I think those are the elements that are now a lot clearer in my mind than they were at the time I started the firm.
Yeah. And it's still, so you're currently a one deal partner firm. Does that ever feel lonely?
Listen, well, first of all, I've got a second partner joining me at the beginning of May.
Okay.
A junior,
breaking news on the podcast chat.
A junior partner, which anyway, we've got 10 years of experience in one of the sort of large cap US firm. Very talented individual. I really can't wait for him to join the firm. And yes, it does feel lonely from time to time. And so obviously there is an element of, in what we do, clearly, it's a team job. It's interacting together, making decisions together is a critical part of what we do. It's what I call a sort of Socratic method of decision making is an essential part of what we do. I've always been a strong believer that 2 or 3 smart people make a much better decision than one person on its own. So that's one of the core element of what I'm bringing in terms of culture of the firm is really bringing that permanent open debate on all the important decisions that we've got to make. And that's something that Apollo does really well, by the way. It's something that I've really liked. But I've always been a big believer of having people sit in the office, having people I sit on the floor. So I have a separate office, but I have an office on the floor as well, the whole team. So that when I'm in the office, I'm as much available for the team as possible to create that permanent interaction with the team. For me, it's essential. And there's a few people that I'm close to, senior advisors and people with a lot of experience that are running other private equity firms in London that I use as regular sounding boards as well. So I do find those through a number of contacted people I've got experience working with. But it's true. It does feel lonely from time to time. And it's the reason why private equity exists, right? Is to help and support CEOs of portfolio companies because they do sometimes feel very lonely. And so I kind of see that as my role on portfolio companies to be here to support them and help them make some of the important decisions they've got to make. And so I've tried to recreate that with a few people that who I trust the opinion of and like to bounce ideas and issues with. I've got a few sounding boards.
And you had obviously a great success last year with the SureServe acquisition. I didn't actually know the statistic. That's the first PE firm where their first deal was a P2P. Probably doesn't surprise me, but what do you think is if you were to pinpoint the key factor or factors which make a PE sponsor less inclined to pursue P2Ps as a strategy, what do you think those are and why are you okay with them?
Listen, I think there's, I would say, two main elements. One is deal certainty, right? Is that uncertainty and unusual nature of the process, where you're not dealing with one seller. And so I think that's one element that makes people uncomfortable. Plus the risk of interlopers, etc. So I think it's the lack of familiarity with the process, which is very different from an organized auction process with an investment bank. And the second element is due diligence, where a lot of private equity firms tend to like to have all the information well set up, well prepared, also vendor due diligence materials and all of that well prepared in advance. And so effectively what you do is more sort of confirmatory diligence in nature.
Yeah.
Right. Well, you don't have any of that on a public to private. So the ability to do outside in diligence and then do what I call sort of hands-on diligence process, design the diligence yourself is critical in the public to private. And so you need that skill set because nothing will get prepared in advance, etc. So you have to do due diligence the old way. And that tends to get a lot of people uncomfortable as well. So you need that skill set, and that's goes back to why I started Cap10, which is bringing that element of sophistication and ability to deal with this sort of transaction complexity into that part of the market where you find other people who do this, but you don't find a lot of people who do public to privates in the mid market.
Yeah. And obviously plans get ripped up, which is we've kind of discussed already. But how do you see Cap10 in the future? Where do you want to get to? How big do you want to be?
Listen, I've got a pretty clear view on that. So I want to keep the team small, high quality. So I don't think the firm will ever go well beyond. I mean, we're trying to build an investment team of about 10 people. I think we'll get there by year end. But if you think about where I want to be in 10 years from now, I don't think that team goes well beyond 20. What I'm optimizing for is ultimately it's AUM per manager, right? Which I mean, is we're going to follow one KPI in what we do, that is the most important KPI in private equity, right? And so what we do, the type of deal we do is high conviction, it's concentrated portfolios. So in fund one, for example, I expect we'll probably end up with 6 investments in the fund. And so we are targeting to raise about 500 million euro of capital for fund one, and with some co-investment on top of that. So we're talking about doing equity tickets of 50 to 75, 80 million euros per deal, which is what we've done with SureServe in the fund. It was total 140 million euros of equity. So we had syndicated about 90 million euros. And so my goal is to create sort of funds where we would do 6-7 investments into the fund and really remain in that part of the market, sort of 100 to 300 million euro EV deals. So could it having funds of 750 to 1 billion euro of capital, and then when we find bigger deals sometime, which will happen, then you raise co-investments on the back of that, and that gives you additional AUM. And then I'm a big believer in continuation vehicles as well. But continuation vehicles for the right reasons is to keep what I say called keep your winners for longer, right? And so I can see us on every fund maybe keeping 1 or 2 or 4 deals for longer period of time, and so that's also how you build additional AUM for the firm. My vision is to really continue doing pure control majority buyout, primary deals, clearly control in nature, and transformational deals. That's really what I enjoy doing, and that's what I want to keep doing. And with a team of fun and smart people.
So final question before we move on to your rollover question. On the website, your favorite quote is listed as follow 3 rules, do the right thing, do the best you can, and always show people you care. What do those principles and values mean to you?
Listen, in what in the sort of transaction that we do, you need some element of relentless. If you want to transform business, if you want to change businesses, you have to really believe that you're right in your approach and not give up. So it's, I mean, you could say there's some element of stubbornness in there, but great things don't happen without a lot of passion, will, and inner fire. And so you need to believe that you are doing the right thing and that you are going to make those changes. Is the right thing for the business, is the right thing for the investment, is the right thing for the people, is the right thing for the overall everyone who's involved with the business. And you have to really care and be relentless about it. And so that's how you achieve great things. I mean, it goes back to the Watch Your Switzerland investment. I can tell you when I started the IPO process and I was meeting investors, I spent a year on the road meeting investors, and it took a lot of convincing. And if you're talking about the highlight of my career, the really successful IPO of that business, which was a small mid-cap retail business in the UK post-Brexit, but didn't exactly tick all the boxes of investors at the time.
Yeah.
And we managed to get some of the best institution on board, the BlackRock and the T. Rowe and of this world in the IPO. And the IPO was, I think, 6 times oversubscribed. Share price was at 15% on day one. It was an incredibly successful IPO. But it was a lot of hard work and took a lot of convincing. And it wasn't a walk in the park. And so that's my point about but I was thoroughly convinced it's a great business. And it just had to make the effort and take the time to explain it properly. And if you did that, then you'll get to a great result. And that's what happened. But yes, you need to care. That's one thing I'm definitely looking for in the people that join a firm is people who are passionate about what they do, who really enjoy what they do, and get up in the morning and come up to work with a smile.
I think that's a great place to end. So all that's left is your rollover question. If you can just write it on the back there. Fabrice.
There you are.
It's been a pleasure.
Tarun.
Thank you for talking
Thank you
to
very much. Pleasure.